Okay, what's good, everybody? Today is Monday, March 3rd, 2025. My name is Luther, and I'm a real estate pro, real estate entrepreneur here in the Kansas City market. And over the last 13 or so years, I've been, active as a real estate pro, looking for opportunities, looking for deals, helping investors, helping everyday home buyers, and just kind of going through more or less the whole process on the residential real estate side of the business, mostly tailored around investors, investment properties, and investment property type services. Okay, so in today's session, I want to dig into the capital aspect in regard to funding and financing for real estate investors, and I want to take that a little bit deeper and talk about balloon payments on mortgages. And then I also want to go a little bit deeper into variable or adjustable rate mortgages. Okay, so the funding and financing is huge for real estate investors. And over the last couple years, I've taken a deeper dive into that as a way to, help me and my partners grow our investment businesses and portfolios, and also to help my clients with their properties and projects and so forth. And so much of the process is heavily reliant on capital and funding. And so as I've taken a deeper dive into those aspects, it's helped me grow and it's helped my clients grow. And so now I'm putting the word out there for my audience and people that are interested in real estate. So if you're tuned in, there's a very good chance that you are already investing or you are wanting to invest in real estate, okay? And that may be for, short-term transactions, or if you're like us, you want to grow a larger portfolio of equity and cash flow types of investments. You're either in that boat where you're doing it or you're planning to do it, right? Or you might be a real estate practitioner or a service provider like myself, and you may be helping other people through the process, okay? So this is going to be helpful if you're in any type of position in regard to investing or helping people to invest in real estate, okay? So look, having some type of capital up front that you're starting with, however much you can access, and then figuring out how you can leverage that capital or place or invest that capital is what it's all about. And the real estate just happens to be the product or the tool or the resource that we're essentially all using to put money to work, right? To either get large returns back in a relatively short amount of time, which is what we attempt to do, or putting the capital to work in order to grow a portfolio that produces cash flow and grows in equity over time, that type of thing. And so I want to get into balloon payments on mortgages because a lot of investors get into different types of loans not really knowing what it entails, but mostly because it was easily available, right? Me included, a lot of my customers and clients, we've used hard money loans in order to get into properties, to be able to acquire them and then to renovate those properties. And a lot of us end up going that route because we may not know any better, or because those types of loans are readily available. And, if you're going to events, networking events, business conferences, real estate conferences, inevitably you're going to meet someone that does private lending or they do hard money loans. And so it's kind of right there in your face, right? But eventually, especially if you're wanting to grow a portfolio, like I mentioned before, that produces equity and cash flow over time, then it's even more important to get a better understanding of the different types of funding and financing that's available for us so that we can save money and we can grow in a manner that could be done more efficiently or with maybe a little bit less stress, or perhaps we can not have to expose ourselves or put ourselves in risky types of investment situations type of thing. So I got the help of ChatGPT again, and I prompted it, asked it a number of questions last night in preparation for today's talk. And I asked it, what is a balloon payment for a mortgage? Okay. And it spit out, a balloon payment is a large lump sum payment due at the end of a mortgage loan term after a period of smaller regular payments. Okay. It is commonly found in short-term or interest-only loans where the borrower makes lower monthly payments, sometimes just covering interest, and then must pay off the remaining balance in full at the end of the loan term. Okay, so I had mentioned hard money loans or short-term loans, okay, as investors, real estate practitioners, those are readily available. Well, those hard money loans or short-term loans have a balloon. Okay, so generally the lender will give you 6 to 12 months, perhaps longer, okay? And then during that 6 to 12 month period, in a lot of cases, you're going to be making a monthly payment to that lender, and it's going to be an interest-only payment, right? So, and they're usually going to charge a higher than normal interest rate in order for you to get that loan, right? So you got to think like, all right, if it's readily available and the application or qualification process isn't as stringent type of thing, then there's usually going to be a catch with that, or there's going to be a reason for that, right? And because lenders perceive that it is a higher risk, they're going to charge a higher interest rate type of thing. And there's going to be certain guidelines and of course documentation and ways that you can use that capital type of thing. So, okay, hard money loan, short-term loan, it has a balloon, meaning that, okay, you're going to get money from the lender, they're going to send it to the title company, and then you may be able to get draws as you're going through the renovation process, is how it usually works. And during that 6 to 12 month period, in a lot of cases, not all cases, but a lot of cases, you're going to be making a monthly interest only payment to that lender. And then at the end of that 6 month or 12 month period, hopefully before that, you're done with the renovation project, and then you sell the property. And then at that point, you pay off the hard money lender or the short-term lender type of thing. Or, if you want to keep the property, lots of investors utilize the BRRRR strategy. You're going to buy it, rehab it, rent it, and then refinance in order to pay off the short-term or hard money loan. Okay, so those interest payments that are being made each month, okay, that's coming from you or whoever's involved in your business. It could be a partner or however that works. And then you're under quite a bit of pressure. You're under the gun, because if you do not perform and pay off that loan or pay the lender back in full at the 6 month mark or 12 month mark, hopefully before that, then they can essentially take the property. You may have to go through a legal process with the foreclosure. Some private money lenders or hard money lenders may be a little bit more flexible with how they do how they handle their default situations. And so they may just do a deed in lieu of foreclosure, or they may just, however they document and take the property back, and then whatever recourse you as the investor has to settle at that point. So that's part of the risk, right? So depending on what is happening in the economy, what's happening with interest rates, what's happening in your specific town or location where you're actively investing or working with investors, the markets and the different conditions based on all of these different factors and then some, is it really worth that risk to you to be able to, have an opportunity to acquire a property and, fix and flip it, or acquire that property, renovate, refinance it, keep it? So just understand, like, the balloon is a big thing, and understanding the terms and the cost of the money that you're utilizing is very important. It's very important for you as an investor, very important for you as maybe a real estate broker or lender, practitioner of sorts, helping investors out. I gotta dive into variable and adjustable rate mortgages. I touched on it a little bit earlier, and I got help from OpenAI ChatGPT again in regards to adjustable rate mortgages. And FYI, me, one of my mentors, some of the people that I know see 30-year fixed rate mortgages that are, fully amortized with no balloon as the gold standard. All right. So there's various reasons why adjustable rate mortgages are attractive. And I think it's similar to why short-term debt and hard money loans are attractive. And a lot of that is because it's what the lenders push, type of thing. So be mindful when you're looking at the different types of loans that are available for business owners, entrepreneurs, and so forth. So let's get into adjustable rate, variable rate mortgages with the help of ChatGPT. Okay, I asked it, what is a variable rate or adjustable rate mortgage? And then I also asked it, why might they be attractive for consumers? Okay. A variable rate mortgage, also known as an adjustable rate mortgage, is a home loan where the interest rate changes periodically based on market conditions. Unlike a fixed rate mortgage, which has the same interest rate for the entire loan term, an ARM typically starts with a lower introductory rate for a set period and then adjusts at regular intervals. Okay, so how ARMs work: you have an introductory period and then you have an adjustment period. The intro period could be 3, 5 years, 7 years, or maybe 10 years. And during that time frame, it usually is a lower interest rate. And then after that time frame is up, then it adjusts based on the market. Okay, so adjustment period, after the introductory period ends, the interest rate resets periodically, and it'll reset either every 6 months or every year based on what's happening in the market. And it's based on index and margin, okay? Which on all this stuff, do your own research, do your own homework, reach out to advisors. If you have questions and want to go deeper, again, you can reach out to me, but learn this stuff. It's going to help you tremendously. Again, if you're investing, wanting to grow a portfolio and keep property for the long term, this stuff is huge. And if you're a practitioner and you're looking to do a similar thing, and in the meantime, you're helping other investors get to it, tap in, learn this stuff, baby. So why might ARMs be attractive for consumers? One, lower interest rate and payments. And this is usually just a teaser at the introductory period, right? Number two reason, more purchasing power, right? With lower interest or with lower initial payments, buyers could qualify for a larger loan, type of thing. Number four reason why ARMs might be attractive for consumers, good for short-term ownership, okay? And number four reason, potential for lower rates in a declining market, right? So if interest rates drop, the loan's rate could adjust downward, reducing monthly payments. Of course, that would be after the introductory period. So those are some reasons why an adjustable rate mortgage might be attractive, okay? So you just gotta look at, dig deep, consider the risk, okay? Risk to consider on an ARM: payment shock is one, uncertainty is two, refinancing risk, okay? So as I mentioned before, when we're doing short-term transactions or we're using, mortgages that have balloons that come due, it makes it not only more risky, but more challenging, but it's more tedious because there's additional administrative and operational work that needs to be done to get through these transactions type of thing. And when the economy shifts, things change in the markets, it may not be favorable for you at the time when that balloon comes due. It may not necessarily be a favorable time to resell, which is what you may have to do, or it may not necessarily be a favorable time to refinance if mortgage rates are up. So that's a key part why, you have to be mindful when you're looking at these loans that have balloons, okay? So who should consider an ARM? Investors or home buyers who plan to sell or refinance before the adjustment period, okay? Buyers in a high interest rate market who anticipate rates dropping in the future, okay? If you want to speculate, I guess go for it. And then borrowers who expect their income to increase, which again, it's hard to say at the end of the period, whenever the balloon is due, what's going to be happening in not just the economy and your specific market, but what's happening with you and your personal life and with the world around you type of thing. So again, plug in with us if you want to learn more. Thank you for your time. And I'm encouraging y'all, investors and practitioners, look into the funding and financing, look into private capital, private equity, how to, raise it and place it effectively, and it's going to help your investing career tremendously. All right, that's it for today. Peace, y'all.